for us that what you should make of the policy announcement. Was it on the expected lines? And we have Dr. Ashima Goel, ex-member of MPC, RBI Emeritus Professor at IGIDR, also with us. Hi Ashima ma'am, great to be speaking with you yet again. So ma'am, help us understand that how do you see the policy results? Is it something that even you were expecting, or is it a surprise coming in?
Yes, last time I had asked for, I had expected a 50 BPS cut in the last policy, and they have done it in this one. So I think what the governor said, front loading, is the key word to understand this policy. They have front loaded monetary policy space, and they switched to a neutral stance from here on. So they are signaling that there's not much space left to cut, but they want markets to pass through for this to affect growth in a positive way, given that currently inflation is really low and is expected to be below their target for the next year. Their inflation forecast has fallen to 3.7%. So with the excess liquidity in the system, so that actual short rates are nearer the lower end of the lag. So that means that the real repo now is around 1%, right? It's below 2% at least, which is very positive because historically we have seen whenever the real repo rate rises above 2%, that tends to dampen activity. So I think this is a positive for the economy. They've used the space they have, taken a front-loaded cut and a liquidity injection to support growth. But I think for the banks, because bank economists have been asking for a 50 BPS cut, which is a big change from their stance in April, because they were worried about liquidity being tight and not being able to pass through and deposit growth being less than credit growth. So we've seen a big change in these 2 months as liquidity became in excess. The growth rate of credit has converged to deposits despite cuts in some beginning in cuts in deposit rates. And now banks are finding it difficult to deploy all the liquidity in credit. And they also think that a cut in rates will help them increase loans, remunerative loans in the system. This is also positive for MSMEs who are very sensitive to the interest rate level. It will reduce NPAs, some stress in the microfinance sector.
All right, this policy seems to be double bonanza in whatever was expected, whatever was anticipated, and economists were penciling in. You expected 25 basis point cut, 50 basis point has come. There was an ask for 50 basis point CRR cut. It has come in at 100 basis point. But there is a surprise too that Reserve Bank of India has now said that shift of stance has happened. Mr. Dinesh Kumar Khara, I would want to come to you for a reaction. 100 basis point cut, will it fuel credit growth?
Well, the CRR reduction of 100 basis point will certainly help in terms of America's cost of funds. It will certainly improve the cost of funds. What will happen is that when this transmission really happens, so actually speaking, there would have been a pressure on the NIM. So I think with this reduction in the CRR by another 100 basis point, it will actually help the banks in protecting their NIM also, because the cost of credit will come down. So I think it's a very welcome suggestion. I would say that it was overdue for quite some time, but now having done it, it will also address the liquidity related concerns which were actually addressed by RBI over all these, for last about 6 months plus through various repo mechanisms. So I think it will actually ensure that there is a system as a whole should be in a position to support itself when it comes to the liquidity. So I think it's a very welcome step. And apart from that, the 50 basis point reduction is also very encouraging. Those stance is, of course, one concern, but I think it's on balance, it's a very welcome policy which has been announced by RBI Governor.
All right, we also have with us Mr. R. Gandhi and Nilesh Shah joining in the panel. Mr. Gandhi, I want to come to you first. The change of stance is something which is left everybody in surprise from accommodative to neutral. What do you think is the reason for that, and what will it deliver as far as RBI's projections are concerned?
That is quite a surprise to the market, of course, but the governor has given the rationale why MPC has decided to do so. First point that we have to appreciate is that Reserve Bank has front-loaded quite a large cut in repo rate and also larger cut in the CRR. That is, the governor really mentioned that he is front-loading the whatever possible monetary policy and liquidity action that Reserve Bank can take, and he also cautioned that this is the thing that we can do. Hereafter, heavyweight will have to be taken by implication by fiscal policy. That's what is whatever monetary policy could do, we have done well in advance, anticipating that we have to support the growth. Since that inflation is quite under control. So we have done quite a lot on what is possible by the Reserve Bank. Hereafter, it has to be by the economy and more specifically the fiscal also. So that is why he has shifted the stance to, or MPC has shifted the stance to neutral, because nothing more we can do. That's the implication there. And if at all, there can be negative depending upon the circumstances, if Reserve Bank had to take opposite action in terms of increasing the rate or anything, if inflation is rearing its head again, then to be in readiness, they have gone to neutral stance. That's my reading.
All right, Mr. Nilesh Shah, I want to come to you for a reaction. In cricket parlance, he has hit 2 shots, which is more than the run rate which was required. You talk about CRR, you talk about repo rate cut, but he has also sent a googly in terms of change of stance. How should market interpret it?
Well, after hitting 2 sixes, when the run rate is well under control, it is prudent to play the next ball cautiously rather than going for a third 6. That's exactly what Mr. Gandhi explained. RBI has front-loaded repo rate cut and liquidity measure to support growth. Now it is time to be focusing on other parts of the economy, other parts of the banking, rather than continue to give hope to the market that more rate cuts are coming.
All right. We want to take a reaction from Mr. Khara now on the announcement which has been made. No further liquidity announcement, but CRR cut has happened. In terms of banks, treasury, do you think this will be a big boon from Reserve Bank of India this time?
Oh, certainly, because, the CRR was essentially the preemption of the money. So now that money is available for lending. And I'm sure with the kind of focus which is there on the growth, which is actually the intent in this policy also, which is very clearly articulated. So I think it will certainly help the banks to, and also for the treasuries also, that they will be in a better position to really improve their overall earning on the portfolio.
All right, Mr. Gandhi, I want to understand from you this dynamics. In one policy, the stance was shifted, another policy gone back to the previous stance. Do you think it will give more flexibility to Reserve Bank of India in future rate of action with the kind of trade tensions and the evolving situations which are there?
That's correct. That exactly is intention, because right now, having done or having exhausted what all possible measures the Reserve Bank can take in terms of rate cut and also CRR cut, they hereafter they have to play safe. They have to clearly look at evolving situation in terms of trajectory, even though the forecast about inflation is quite benign. But obviously, central banks would always like to be cautious. That is why they have shifted the stance to neutral. That doesn't mean that they will hike the rate or anything. No, they are, as you mentioned, they are they are keeping themselves in readiness to move either way.
And Goel ma'am, I want to come to you. And ma'am, we have seen some tones of underlying concerns coming in from the governor's speech, while all else seemed positive. There's one statement that I want to ask you about, which is at the very beginning of the speech. He said MPC is left with limited space to support growth. Now, while all seems in control, the inflation is back to the government's target. Do you think he has already given us an indication of what we could expect from the next policy meeting, which could be no action at all or no change in rates? Because like Mr. Nilesha also mentioned, it's time to play slow now. On the flip side, for Q4 of this year, this financial, he's expected the inflation to inch back up to 4.4%. So what could the next policy look like?
Yes, I think what, again, as I said, the key word is front loading. They have front loaded the space they had to cut in order to stimulate pass through and the positive effect on growth. So a neutral stance allows them to move in any direction. They can pause, they can cut, or they can raise. So therefore, the next policy will be data-based. If there is a sign that that inflation is persistently going to be below 4%, they may have space for another cut. If, as the current forecast in Q4, it will be back to about a little above 4%, then they're likely to pause. So it will be data-based. It will depend on how the inflation and growth numbers pan out and which needs to be supported more. Right?
Appreciate that view, ma'am. We also have Abhik Barua, who's joining us on the show. He's an independent economist. And Abhik, hi, thanks so much for joining us on the show. Now, what I want to talk to you about is the dual thrust that has come from the RBI on the reduction in the repo as well as the CRR. Now, would you believe the RBI is trying to send a dual signal over here, because this also affects the price as well as the quantum of money supply in the economy? Which one of these parameters do you believe will start affecting the economy sooner, and where do you believe in terms of macros we're headed ahead?
Well, I think this was a very clever tactical move to take advantage of the current low inflation scenario and front load the rate cut, which I incidentally had argued for in different forums. And I think Ashima explained this very well, that going forward, the element of data dependence creeps in. And I think we tend to forget the fact that the global inflation situation is still very fluid, and it could just as well spill over to India.
Mr. Shah, I wanted to have your take on the markets as well, because this particular move by the RBI, the markets are rejoicing the fact, yes, it's been a bit of a surprise, but Mr. Shah, which sector can actually surprise on the upside? Because this news flow is indeed positive for banks, NBFC, real estate, and the list is long.
So it's not a bit of a surprise. It's a big surprise. After nudges in the initial power play, RBI has changed gears by front-loading pro-growth measures. Both the bond market and the equity market has been positively surprised. The yields had gone down from 620 to 612 based on 50 basis point rate cut. It bounced back to 620 when they realized that stance has changed to neutral. And again, it started coming down when the CRR cut announcement came. Same thing happened in the banking sector and broad market. It came down when they heard repo rate was cut by 50 basis points, as it would have impacted banks' NIM margin. Bounced back once they realized there is CRR cut happening. Overall, I think both debt and equity market will be positively surprised by this front loading of growth measures. And now, actually, I have a worry. I hope President Trump doesn't borrow RBI governor to manage US Fed.
All right, Mr. Khara, help us with your take on the banking space, because this too has been a big booster. So which particular move you believe can be a big booster, or rather a better booster for the banking space? Is that a CRR cut that the banks will be working, or is that the overall decline in the repo rate that the RBI has announced, and what does it really mean for the banking space?
Actually speaking, if at all you look at the structure of interest rate in the banking system, wherever it's linked to the external benchmark, then the transmission happens immediately. But when it comes to repricing of the liabilities, it takes some time. Normally there's a lag of about 6 months to a year. So I think repo rate reduction would have led to that kind of a compression on the NIM. But nevertheless, the reduction in the CRR is something which will actually reduce the cost of funds for the banks overall. So that is something which will actually turn out to be very positive, because whatever impact would have come in for the repo rate reduction, that is actually getting compensated, or maybe more than compensated, through the CRR reduction. So I think, to my mind, this is the CRR reduction, and also availability of ample liquidity in the system is actually helping the banking system, and it will go a long way in terms of supporting the banks.
All right, I want to come to you, Ashima, for a question. You have been in MPC earlier, so you would understand this better. This change of stance which has happened from policy to policy. Last time when you were in MPC, there was a lot of question about the stance of Reserve Bank of India. Do you think it has been adequately answered now by Governor? And second question on inflation growth dynamics. While there is a revision in inflation forecast, growth target has been kept intact for FY26. How should one read it?
Yes, I think the governor has clarified in one of his earlier speeches that the stance now is with respect to the repo rate. So a neutral allows flexibility in any direction. In the earlier MPC with Governor Shaktikant Das, it was linked to, because it was the post-COVID period and large excess liquidity had been created. So there is one more, couple of other issues I want to flag about this front loading, and it is that we should recognize that with inflation targeting, our volatility in inflation is going down. The CPI, the range within which it moves is much lower than it was earlier. It is not going as high as 6 and 8%. And therefore, the degree of change required in the repo rate is also lower. So markets that were expecting a repo rate, a terminal rate at 5 and even negative real rates should realize that you don't need that kind of large repo rate movement. So what the governor has communicated is that we have used the space in a front-loaded manner, and now it depends on how inflation and growth pans out. Yeah, he's kept that flexibility. And that comes to your question about the change in the growth forecast staying the same. So as has been remarked, there are some stresses in the system, some negatives from this volatility we are seeing in the global regime. And there are positives on inflation, softening in oil prices, good monsoon. So the inflation rate has been brought down. But, this is another nice thing about this policy, because in the past, what the RBI is always afraid that inflation will come up again. In 2015, when oil prices fell, they did not cut the repo rate because they were afraid oil prices would rise again. So here their forecast is 3.7 for the year, although it's rising to 4.4 in Q4. But they have taken the cut now so that the real repo rate does not rise with the current fall in inflation. And they have given themselves room to respond as inflation changes. It might be that inflation continues to fall or is anchored around 4%. Some research I've done suggests that firms are starting to internalize that 4% benchmark, and they are not passing on commodity price inflation as much as they used to earlier. So if indeed our inflation is getting anchored around 4%, we'll see much fewer changes in the repo rate, much smaller range of changes in future. And I think this change of stance points towards that the RBI is not overreacting, is not cutting too much, or the market should not assume that there will be too many cuts, because that leads to, that increases volatility in the.
All right, thank you so much, Ashima Goel, for joining at this hour. I want to come to you, Mr. R. Gandhi, for the question on growth front. While there has been no revision on the growth guidance, Governor has mentioned that they have done enough in this policy as far as the rate cut is concerned. 50 basis point has been announced. I want to understand from you, now the options from Reserve Bank of India are limited to push growth?
Yes, that is a first implication we have to read, that whatever possible in terms of cutting the rates and increasing the liquidity, the Reserve Bank has taken action. Because any more cuts can disturb the household savings. Because household savings, now the interest rate will be still further down, because totally in this last three policy announcement itself together, it is 100 basis point cut. So it can affect negatively the household savings. So that is why they are cautioning that by any more cuts, if it is done, then it is going to be difficult for savings to be encouraged. So that is one thing Reserve Bank obviously has kept in mind, to indicate that don't expect some more cuts automatically. That all depends upon evolving situation. That is number one. Number two is that in the fourth quarter, the inflation forecast is 4.4, and if the growth gains momentum, then it can lead to further increase in inflation. So at that time, obviously, Reserve Bank will have to ready itself for taking action on the other side. So that is why the neutral stance. That's it. So a growth in any case, growth has always not the primary weapon, cannot be monetary policy. For growth, it has to be beyond monetary policy. So that's why indirectly indicating that whatever we can do from monetary policy angle or liquidity angle, we have already done it. Hereafter, it has to be shouldered by other forces. So both private investment, they will have to get higher confidence and encouragement because of these rate cuts. So that will increase the growth momentum. And fiscal policy also, if further impetus is coming or public investment continues to be robust, then the growth trajectory could be more. So that is a second. Another caution which he has mentioned is relating to international situation, that even though today oil prices are very benign, that is on the positive side, but the geopolitical situation can disturb the situation and the tariff related impact. So these things have been definitely been kept in mind. So that's why you are right in the sense that for supporting growth, now the forces which will have to be encouraged is beyond the Reserve Bank.
Okay, appreciate that view, Mr. Gandhi. Let's just talk about the recovery that we've seen in the Nifty, flashing on the bottom of your screen, a 1% uptick coming in from the day's low. Nifty Bank also at all-time high, looking very good. We also now have Mr. Sriram Ramanathan of HSBC Mutual Fund joining us on the show. But Mr. Ramanathan, before I come to you, I want to take a question with Mr. Nilesh Shah. And sir, help us understand the impact that you see of this surge in liquidity that will now eventually take place, the impact of that on the bond market. Do you believe the bond yield curve would flatten out? Because we did see a little bit of a spike coming in around 10-15 or so when the announcement was made about the surge in liquidity. Where do you see the bond market headed from here?
So the bond market's immediate reaction will be to do a parallel shift down. The short, medium, long all will come down to reflect 50 basis point rate cut adjustment. Then the short end may come further down because of the liquidity measures. From having probably adequate liquidity, or maybe if I can begin, there was a time when there was excessive liquidity of more than 10 lakh crore in banking system. then it became adequate liquidity, then it became deficient liquidity, then it again became adequate liquidity, and now we are probably at the stage between RBI OMO, the dollar swap, and the RBI dividend and CRR cut. About 12 lakh crore of liquidity has been imparted into the system. Clearly, when liquidity improves, the short end comes further down. The spread between 10 and 30-year is 60 basis points yesterday evening. I'm sure that is likely to narrow further. So we will see first parallel move down on yield curve, then short yield curve coming further down, and eventually long end of the curve also coming down a little bit.
When the stakes are high and the answers are elusive, there's one voice